It does lead us to our talk of the tape, whether NVIDIA's meteoric rise has happened too fast, and if that incredible run has left the market unstable now. Let's ask our panel. Malcolm Ethridge is Vice President of CIC Wealth, Bryn Talkington, Requisite Capital, Stephanie Link, Hightower. All three are CNBC contributors. Good to have everybody here. Bryn, I'm going to begin with you because you're the one who owns NVIDIA. As I said, it had this quick correction of 10%. What do we make of that? Should we be concerned about where this stock is today?
I think it's so healthy. We would be concerned if it just continued to go up 2 to 3% a day. If you just look at basic technicals, it was so far above the 50-day moving average. That number is like close to $100. I doubt it gets there, but it needs to take a breather and consolidate. And I feel quite confident sellers will come in. But remember, earnings don't come out until August 21st, so it's like the very end of earnings season. So there's definitely some time to digest, think about, let it sell off a little bit. But once again, I feel really confident sellers are going to come in because they're going to have another spectacular earnings quarter on August 21st when they crush it year over year on revenues and earnings.
Yeah, you know, I mentioned the meteoric rise, Malcolm, that this stock has had. I read this stat earlier on Halftime Report, and I find it astounding. Maybe the most incredible stat that I've ever seen. NVIDIA has added more than $880 billion in market cap in 21 trading days. In 21 days. That's incredible.
Well, so your question about whether we're likely to see the slide continue or if this was just sort of a blip, we just got, as quickly as NVIDIA has rallied, we just got a bear market that fast, right? So escalator up, elevator down. But I think it's a bad idea to bet against NVIDIA here, right? The last couple of years, if you did from about 400 to today, you would have been wrong, right? So I think NVIDIA is one of those that it's good to own in proportion to the rest of the portfolio, but it's a bad idea to go chasing here.
Hey, this is not betting against, too. Let's parse those words a bit because, you know, you could still love the stock and look at the rise that I said, and then when I read that number, the $880 billion in market cap, and just say now is the time to, you know, cash in or take a fair amount off the table rather than continue to buy in. That's what I'm assuming that clients are asking people like you, who may not have as much exposure as their friends or others. They hear about this story, you know, nonstop and are wondering, what am I supposed to do now?
So I was watching Halftime earlier, right? I saw the guys talking about trimming their positions, well, save for Jason, right?
Yeah,
but the guys were talking about
two of the three who own the stock.
They're trimming their positions, but I didn't hear anybody talking about, after I've taken those paper gains and turned them into cash, I'm going and buying Apple, I'm going and buying Microsoft, right? Those are the three-horse race right now for the largest company. So what I do think there is potential for is for investors to be rotating some of that cash into other mega cap names that have fallen out of favor a little bit, especially with earnings coming up in a couple of weeks. I think names like Meta, names like Amazon, they will start to get some love again. And so it's just rotating those winnings over to what you expect to be the next winning horse.
Hey, speaking of, didn't you buy some more Amazon?
I did. I bought Amazon today, so I'm in a way talking my own book here.
Okay.
But I do think that Amazon is one of those names that has a lot of potential still locked up in it, and it's not quite getting the respect that it deserves just looking at the digital advertising component of it and their push into ad-supported revenue in addition to AWS and e-commerce.
Steph, you watch a lot of markets over the years. I mean, when you see something like NVIDIA, which has accounted for a third of the S&P 500's gains this month all by itself, and then I told you the astronomical number of market cap that this stock has added since earnings in 21 trading days. What do you take away from that?
Yeah, I mean, like, there's total euphoria over this name, and it's totally overcrowded, Scott, and you have 89% of the sell-side analysts that have buys on it. So where's your incremental buyer and where's your incremental support on the sell side? So I think it's a little bit challenging. It got a little bit stretched, to Bryn's point. I don't think the party is over, but it's had a heck of a run, and there are so many other places within technology that offer better, attractive risk-reward. And you know, I've been a big fan of the PC refresh cycle. I think that area is very interesting. Not a lot of people are talking about that. And those stocks, like HP HPE, HPQ, Dell. I like Seagate, CDW. Even Apple is going to have a Mac refresh. So I think that's an area or those are areas where are more attractive. Nothing is wrong with NVIDIA. It just got really overloved really, really quickly. And so if it does take a pause, if it does pull back, there are going to be opportunities, just like the last drawdown in March, where it fell 20%, went sideways for a while, and then eventually recaptured better gains ahead. Because the story for AI, it's not over. You're in the second innings at the least at this point.
That's why when you say we're in the second innings, it's hard to actually know whether a stock like NVIDIA has gotten, quote unquote, overloved. Maybe it's justifiably loved. The target today at Melius Research goes to 160 from 125. Others are weighing in on the euphoria, what they sort of the commentary from some that suggests this is too euphoric. They say all-time highs, yeah, okay, I'll give you that. 99? No, hardly. We're not like that. Is it overloved or is this totally justified? We're just not used to seeing anything like this. So to the layperson, you look at it and you're like, this is crazy. This stock shouldn't be going up like it has.
I think you're right on both points. It is overloved and it is justified. I feel really strongly the 99 comparison is a lazy comparison. Cisco never even remotely had the earnings power. None of those companies. I mean, NVIDIA from October of 2022, which was like the lows, had a $280 billion market cap and a forward PE of 25. It's a $3.1 trillion company, and what does it have, a 33 or something like that PE? And so it's like justified. The earnings have held up. And so I think we're in uncharted waters where I've been in the market since 94. I've never seen a company's earnings grow so quickly with their market cap. I think what will ultimately happen, and maybe it's a 25 thing, and the market will sniff this out early, maybe it's a 26, is when those year-over-year comps stop being 100% and start being 50 or 40 or what have you, because you do have to digest. These Microsofts and Googles and Metas can't just keep buying the GPUs. They have to digest them and then start to monetize. So when that happens, there will absolutely be a sell-off in NVIDIA. But I think investors right now, I think to Malcolm's point, you have to size it right in your portfolio. I mean, I sold, when the stock hit 130, I sold on October 150 calls and got close to $10 a premium. So I'm really comfortable doing that. I think it's going to trade sideways. But if in October it gets called away, the part that I sold, I'm comfortable with that. Because you don't want to fall in love with any stock, and you want to be smart about the positioning.
It's hard not to fall in love with this one. I mean, because when you're at 900, you're like, I can't continue to go up like this. And then it gets to 1,200, and then you have a split. And now it goes off to the races again. I'm just wondering, Malcolm, whether you think this has in any way left the market unstable. It's the word I used at the top, because if you look at under the hood of the market, as Bespoke suggests today, more than half of all sectors within the S&P 500 haven't had a new high in at least 2 months. Okay, 2 months. Energy, industrials, materials, healthcare, discretionary, and real estate. Yes, every sector but one is up on the year.
Sure.
But more recently, you've become very top-heavy. Has that made us unstable in any way or not?
I don't think it's made us unstable as long as the AI narrative continues to have power. So as long as those names that lead the pack today, and there will be a reversion to the mean, right? We're looking at Apple, I think, just hit 30 times forward earnings. NVIDIA is at like 43 times forward earnings. You've got Microsoft at like 34, I think is the number, versus 27 or 28 on the NASDAQ. So there will be a mean reversion and there will be some rotation, as I've been saying. But I think we can still continue to hang our hats on those 5 or 10 names that are really powering the AI narrative, because those are the only ones that are showing a true path toward monetization of the technology. And the market is going to continue rewarding those companies that can show that clear path quarter after quarter.
Steph, you've been making bets in the areas of this market that I said are made up of the half that haven't had a new high in at least 2 months. Where others see more recent pain, you see more exposed opportunity, perhaps, that exists in those areas. But they need to start performing again.
Yeah, they do, but I do think that they will. I do think we're going to continue to see, like we started to see this week, a little bit of a rotation. It's only a little bit, but I think we're going to continue to see that, especially as we hit earnings. We have to wait until July 12th. So the next 2 weeks kind of might be choppy, but July 12th is when earnings start. And I think earnings for these other sectors are going to be pretty good. And I say that because I look back and I review all of the economic data. And I know the economic data this week was kind of mixed. I know it was weak on housing, but I still believe very strongly that you're running at about a 2 and 2.5% clip on GDP. Inflation is coming down, margins will be good, and there are certain themes that you want to play in industrial, certainly the grid and power and green and clean, and I think, and I'm very exposed in that theme. I think cybersecurity is going to be very strong, and it's really not loved. I mean, maybe CrowdStrike is, but for the most part, a lot of the other names are not doing as well, and I think they're going to come in with very good earnings. I think some of the consumer discretionary also will be good. The consumer is still solid. And so I think there are other areas, Scott, in addition to energy. Energy has been the most frustrating year to date. But I do think that if the fundamentals are there, eventually people will respect them and want to own good fundamental stories that are attractive. But the fundamentals have got to come through. I'm betting that it will.
I know that, Bryn, down in your part of this country, you know, they're hopeful that the energy trade is legitimately re-emerging, if you will, because it looks like it's woken up lately. I don't know whether you believe that this is some, you know, a new run that these stocks are going to have as oil has continued to climb as well.
So the energy complex in general had earnings deceleration. And there's a viewpoint, and we'll see if that comes to fruition over the next couple of earnings quarters, that's actually going to start reaccelerating. But what I know for certain is there's a ton of M&A in this space. You can go from big to small, a ton of M&A. They are being active. There's only so much oil in the ground. And so I think that as long as these companies stay capital disciplined, you can put together a portfolio of names that can give you capital appreciation, but also dividends, plus those flexible distributions that they make over time to put together a nice return. Is it going to be an NVIDIA return? No. But can it add consistent return over time? I would say absolutely yes. I think that capital discipline is going to stay in this space, and that's what investors need to continue to see to be comfortable taking a longer-term allocation.
You like that space, Malcolm?
Energy?
Yeah.
I'd rather own cybersecurity. I think Stephanie set me up perfectly with the case for why cybersecurity is the next leg in tech. She talked about the fact that it doesn't get the respect that it deserves. You've been hearing me.
It doesn't get the respect that it deserves. You take a look at
one name, two names.
Have you looked at CrowdStrike recently?
I look at it every day. Palo Alto, I'm waiting on the resurgence. I was happy to see the major upgrade. But other than those two names, can you name me two more that anybody is as passionate about? I think
Steph's passionate about Fortinet. She just didn't mention it because it hasn't made her happy lately.
Which is kind of my point. So I sold off SentinelOne, I sold off CyberArk, and I bought CIBR, the ETF, because other than those two names we all talk about every day, there's really no clear consensus around which two or three other names are going to join the party. Mm-hmm. But I do think there's a case now for consolidation among a lot of the cybersecurity providers. It's a very fragmented business that needs to have some consolidation to get to this platformization that we've been talking about. That's the word now that has all the juice in the world of cybersecurity. And so I think that when we talk about those two names, it's good to be directionally accurate. I'd rather not have to make that big bet on a name like Fortinet or some others. And so in my case, I decided to go ahead and buy the ETF and just see who emerges as the leader.
Makes us wonder at least a little bit, Steph, whether the software trade, you know, these stocks obviously fall within that trade, and many of those stocks within the software sector have gotten clobbered. Yep. Whether money is going to start coming out of some of the biggest chip winners and then go into software at perceived value levels. I think, didn't we see Salesforce, for example, was leading the Dow yesterday in what was a pretty good day? I don't know if that's the beginning of something or not.
Well, there's certainly value in the software space. And when you look at the SMH as a whole, it's up 52% this year alone. That's incredible. So it's not just NVIDIA. And so I have no problem with people taking profits and rotating into where there is definitely value. I happen to think, as I mentioned, I think cybersecurity is one of the areas. That's where I'm focused on. Yes, I didn't mention Fortinet, but I talk about it all the time. I feel like I'm associated with the name. I do think they're going to come through, especially in the second half of this year. Comparisons get easy. Their bookings are building. Their backlog is also growing. Margins are expanding. Free cash flow is going higher. So I think there was just a pause in terms of spending from the CTOs. And I think you're going to see a resurgence from the CTOs, because we're hearing from them that there are two places and only two places that they're spending money this year. And that is AI for obvious reasons. And that is cybersecurity, because, Scott, they're afraid of losing their jobs. You wake up one day and your business is blown out. I just point to United Healthcare having a $1 billion plus problem overnight. So I don't have any doubt long term that this trend is going to be very good. Maybe short term, you have these puts and takes and volatility, but I want to use that volatility to be buying, especially the companies that haven't participated, again, given these tailwinds for the long term.
I'll tell you what's not lost on me either. It's 16 and a half minutes in today. We haven't talked about interest rates. We haven't talked about the Fed rate cuts or anything like that. And to me, that's representative, Bryn, of where this market is now. I think we're over the obsession, because we feel like the economy is good enough, that earnings are going to be good enough, and that if rates are coming down a bit on their own because inflation is starting to get even closer to the Fed's target, that rate cuts at this moment are irrelevant to what this market is going to do over the next few months.
I think we have settled in that we'll probably get one rate cut sometime this year, when the market doesn't seem to care. But if it pushes into 25, that seems to be okay. I think the consensus is, especially as long as the long end, which the market controls, continues to have a solid low four handle, people are like, that's okay, that's good for the economy. And I think that the consensus is, if we start to have rate cuts, it's because unemployment's kicking up and something bad in the economy would have to happen. So I think that's really positive, because you really want this market to have the invisible hand of the Fed out of our environment and let us just run on our own accord and have our earnings, momentum, sentiment drive returns, not what the Fed isn't doing or what Neil Kashkari is or isn't saying.
That was the Keith Meister viewpoint this week when we talked to him here on Closing Bell. Rate cuts are bad for the market because they're going to happen for the wrong reasons. They're going to happen because of a problem with the economy, whether it's unemployment going up or just the softness that could be apparent, and then they're going to have to cut. Ankur Crawford here yesterday said, I don't think they're going to cut at all this year. Malcolm, we've stopped talking about the Fed for, the most part. We were leading almost every program talking about rate cuts, this, that, and the other thing. And now we don't talk about it that much, which is probably a good thing.
Well, big tech is in control of this market now, not the Fed. And I think for good reason, like you said. I think, to your point, if a cut does happen this summer, maybe even September, it would startle the markets to think that something is underpinning that decision, whether it actually is or not. So it would be bad for markets, which is absurd to say at this point, when this time last year we thought that we needed cuts in order for the market to get to where we are today. But now I'm in complete agreement that the Fed is not in control of this market, and I hope that they'll wait until 2025. I don't expect we'll get a cut this year. I hope that they'll wait until 2025, and then we can worry about making our markers from there.
Well, we'll see. All right, we'll leave it there. Bryn, thanks. Steph, you as well. And Malcolm here on set with us at Post 9. Thanks. We'll see you soon, too.